Hello and welcome to Curious Minds, the podcast for people who love to learn. I'm your host, Violet.
And I'm Sophia. It's great to be with you all today.
Today, we're diving into a topic that can sound really complicated, but is fascinating once you get the hang of it: the stock market.
Exactly. We're going to roughly break it down and answer the question. How does the stock market actually work? No confusing jargon, we promise.
So, Sophia, let's start with a really simple idea. Imagine a huge, successful company like Apple or Nvidia.
Okay, I'm picturing it. Lots of shiny gadgets and AI servers.
Right. The stock market allows you to buy a tiny, tiny piece of that company. That little piece is called a stock or a share.
So when you buy a stock, you're not just giving them money, you're actually becoming a part owner?
Precisely. You own a small fraction of the company's assets and potential profits. It's like owning one single brick in a giant skyscraper. You don't own the whole building, but you own a part of it. It's important to understand why companies do this. When a company decides to go public, it's offering these small pieces for sale to raise money. This money, or capital, can be used to grow the business, like funding research for a new product, expanding into new countries, or building new factories.
That makes sense. So if I buy one share of Apple, does that mean I get a free iPhone?
Ha! I wish. No, you don't get free products, but if the company does well and makes a lot of money, the value of your brick, or your share, can go up.
Okay, so that brings us to the big question. Why do the prices of these stocks go up and down so much? Sometimes it seems totally random.
It often feels that way, but it mostly comes down to two key ideas: supply and demand.
Ah, I see. So the classic economic duo?
Indeed. Demand is how many people want to buy a stock. If a company announces a revolutionary new product or reports huge profits, lots of people will want to buy its stock. With more buyers than sellers, the price gets pushed up.
Right, everyone wants a piece of the success. So supply would be the opposite? How many people are looking to sell their stock?
Exactly. If the company gets bad news, like a product recall or poor sales, people might get worried and rush to sell their shares. When there are more sellers than buyers, the price falls.
So it's a giant tug of war between the buyers who are optimistic and the sellers who are pessimistic.
That's a perfect way to put it. And that tug of war is happening millions of times a second for thousands of companies.
So when people talk about investing versus trading, what's the difference? Do they just use different apps on their phone?
That's a great point to clarify. Long-term investing is like planting a tree. You buy a stock in a promising company and you hold on to it for years or even decades. You believe that over time, the company will grow and your investment will grow with it. You're not too worried about the daily ups and downs.
Okay, so you're in it for the long haul, waiting for the tree to bear fruit.
Right. Short-term trading, on the other hand, is more like being a weather forecaster trying to predict if it will rain in the next 10 minutes. Traders buy and sell stocks very quickly, sometimes within the same day, to try and profit from those small, rapid price changes.
That sounds much more intense and stressful.
It can be. It requires a lot of attention and carries different risks, which brings us to a crucial point: risk. The value of stocks can go down, not just up.
This is the part they warn you about, huh?
It is. There's no guarantee a stock price will rise. A company can perform poorly, an entire industry can face challenges, or the whole economy can hit a rough patch. Trying to predict short-term market movements is a bit like trying to predict my mood before my morning coffee. Highly unpredictable.
Great example, and I will definitely not be investing in that. But it's a good reminder that you should never invest money that you can't afford to lose.
That is the golden rule.
Speaking of the whole market, I've always heard people on the news talk about things like the S&P 500 or the Dow Jones. It sounds like a secret code. What are they actually talking about?
That's a fantastic question. Those are called market indexes. Think of them as a report card for a whole section of the stock market. Instead of tracking just one company, an index tracks the performance of a big group of companies. The S&P 500, for example, tracks 500 of the largest and most influential companies in the U.S. So, let's do a quick summary of what we've learned today.
All right, first, a stock is a small piece of ownership in a company. You're a part owner.
Second, stock prices go up and down based on supply and demand. How many people want to buy versus how many want to sell.
Third, long-term investing is like planting a tree. while short-term trading is more like predicting the weather minute by minute.
And finally, and most importantly, investing always involves risk. Prices can and do go down.
I think we did it. The stock market explained. Hopefully it feels a little less mysterious now.
That's all the time we have for today. Thank you for tuning in to Curious Minds. We hope you're leaving with a little more knowledge than you came with.
Join us next time for another dive into a fascinating topic. Until then, stay curious.